The next factor to be considered is the extent of access your company has to the capital markets. Generally, bigger companies have greater access to capital markets than the smaller ones. So these companies are not really dependent on retained earnings. In this case, as it is not completely dependent on retained earnings, they can declare and pay more dividends. For small and medium-sized companies where they have to depend on loans and retained earnings for their capital needs, for them it is not a viable option to declare dividend if they have some major expenditure coming up. And this will also make them to retain their current year profits. So, the extent of access your company has to the capital market is an important factor to be considered. The next factor is legal constraint. What is a constraint? A constraint is a condition or a restriction which limits your freedom to do what you want. So, a legal constraint is a restriction on the company imposed by law. In this case, there could be some legal provisions in law imposing certain restrictions on distributing dividend. So you might have to refer to these provisions and check if it applies to your companies. If yes, then you might have to consider that before declaring a dividend. We can explain this with an example. If you take the company law in India, it has a number of provisions relating to distribution of dividends which has to be mandatorily complied with before distributing them. The next factor is contractual payments. Imagine you enter into a loan agreement with your creditor and there are some restrictive clauses, meaning some restrictions on agreement regarding the dividend distribution by your company. They may state in their agreement that your company must not pay dividend unless and until your profits reach certain level. They generally do this because they want to ensure that the loan doesn't turn bad and they want to protect themselves by inserting such restrictive clauses. So, if this is the case, you have to make sure you're following such clauses before declaring dividend. Otherwise, your company will be in trouble. The next factor is stable dividend policy. Before discussing that, let us understand what is a policy. A policy is a set of principles or standards that a company establishes. Policies are very important and every single company has one or more policies. These are generally established to make sure that the company travel in the right direction towards achieving its long-term objective. In this case, a dividend policy is a policy imposing some restriction or rule on dividends. For instance, a company may have a policy that it will maintain its dividend per share at $1.56 at all times, and this will be irrespective of the profit positions. If your company has such policy, then you might need to take that into account before distributing dividends. Let's now try to understand the difference between shareholders' preference of stable dividend and your company's policy to distribute stable dividend. In the earlier case, it was a preference by shareholders, and in this case, your company willingly decides to keep the dividend per share constant. How do you calculate dividend per share? Dividend per share, shortly called as DPS, is the total dividend paid out in the year divided by number of outstanding shares. What are outstanding shares? Outstanding shares are nothing but the shares currently held by shareholders. There are many companies who actually maintain stable dividend policy even today. So if your company policy talks about maintaining stable dividend every year, then you have to consider that. To conclude, we've been talking about 12 factors which have an impact on the company's dividend decisions. These factors influence the decision of top managers when they want to declare dividend. The decision to pay out dividend would become faulty if they don't think about the other factors before making the dividend decision.